The question of Bitcoin's value. What if the most powerful arguments for Bitcoin's value are nothing more than a well-crafted, fragile illusion? This essay argues that Bitcoin's perceived value is a fragile construct built on twin pillars of pure speculation and ideological belief. Bitcoin also lacks any of the intrinsic utility that underpins truly productive assets. Main argument 1. The foundation of Bitcoin's value. Reason 1. The greater fool theory. The greater fool theory describes a speculative investment strategy where someone buys an asset not because they believe in its intrinsic value, but because they believe they can sell it to another investor, a greater fool, at a higher price later. This is not merely a speculation. Bitcoin is greater fool theory in its purest form. A significant portion of Bitcoin's buyers are driven by speculative motives, often reacting to price movements rather than underlying technology or economic principles. Speculators are often chasing the line go up narrative, buying based on the hope that someone else will be willing to pay an even higher price later on. A person sees their neighbor make 20% gain in a week and, fearing you're not missing out, buying in at a new high, not because of the change in Bitcoin's fundamentals, but because they believe the price will continue to rise. Bitcoin could have skyrocketed over 100% or crashed to 50% from the peak, and people will still be arguing over the true value of Bitcoin. Some people holding Bitcoin are heavily influenced by market sentiment, speculation, news cycles, and high volatility. Some people that hold Bitcoin believe it has no fundamentals like earnings per share or a balance sheet. But proponents would argue Bitcoin does have crypto fundamentals like scarcity, security, hash rate, network effects, utility, and decentralization, the adoption by institutions, but these crypto fundamentals don't produce anything tangible. While some holders point to crypto fundamentals, these are not fundamentals in the way a company's balance sheet or cash flow statement is. They are self-referential properties of a network that only has value as long as people agree that it does. This is circular logic that brings back to speculation. Bitcoin's cap supply of 21 million coins combined with its halving events creates a deflationary pressure that contrasts with fiat currencies. This inherent scarcity is a key driver for speculative value. So if you want to sell Bitcoin at a higher price than the time you paid for it, Bitcoin has value to you. Reason 2. Ideology and belief. Bitcoin is decentralized, meaning there is no single point of authority. This catalyzes Bitcoin being very hard to influence if you're a government. This further leads to Bitcoin resonating with specific political and economic philosophies like anti-government, pro-free market, libertarian and anarcho-capitalist ideologies, and gives the Bitcoin holder some level of anonymity. This appeal translates into the values of those who believe in Bitcoin's fundamental principles, which are individual liberty, financial sovereignty, resistance to central authority, censorship resistance, community, trust in code, anti-establishment, and an anti-inflationary stance. So if you are ideologically aligned with these core principles, Bitcoin will have value to you. For example, people in countries like Venezuela and Argentina, which have experienced staggering hyperinflation and government-imposed capital controls, are often drawn to Bitcoin. For them, it's not just a speculative asset, it's a tool for financial sovereignty. It's a way to escape national currency that is losing its purchasing power by the day and to bypass a system that restricts their ability to move their wealth. This appeal to individual liberty and resistance to central authority gives Bitcoin a profound ideological value that drives adoption regardless of its short-term price volatility. It's easy to dismiss this intense feeling as irrational, but for a person in a country with a collapsing currency, the belief in an alternative is a rational response to an irrational economic situation. This ideological intense feeling is not merely a philosophical stance. It's a powerful force that drives adoption and facilitates the hold on for dear life mentality, creating a dedicated user base that is less likely to sell during market crashes. This loyalty is a key component of Bitcoin's value proposition as it provides a floor for its price and is decoupled from traditional finance metrics. While the first pillar is driven by speculation, the second is driven by unshakable belief that provides a key stabilizing force even in market downturns. This ideological intense feeling creates a loyal, non-liquid user base that acts as a price floor, effectively giving Bitcoin a value in the absence of traditional economic metrics. While the greater fool theory provides that explosive upwards momentum, the ideological intense feeling provides a sticky, residual base that prevents a complete collapse, a crucial distinction that separates Bitcoin from pure pump and dump schemes. A deeper analysis reveals two core drivers of Bitcoin's value. While other factors exist, they are secondary to the two primary pillars. Main argument 2, debunking pro-Bitcoin narratives. The digital gold argument debunked. The most powerful arguments for Bitcoin rest on a single, fragile premise, that it is digital gold. People who are pro-Bitcoin often compare Bitcoin to gold, another asset that doesn't generate cash flow, but this comparison breaks down upon closer inspection. Gold's value isn't just a matter of belief. Gold's value is rooted in its physical properties. It can be melted, molded, doesn't rust, it is highly conductive, it is used in electronics, dentistry, jewelry, and industrial processes, even if its monetary value plummets. Gold has been a store of value for thousands of years, not just because of the physical properties, but because of the deep historical and cultural consensus. Bitcoin, in contrast, is a recent invention. This tangible utility gives it a value floor that isn't entirely dependent on market sentiment. Bitcoin's value, in contrast, is like a secret handshake. It only works as long as everyone agrees to participate. Bitcoin's utility as a medium of exchange or a censorship-resistant tool is entirely a function of network effects and user belief, and is only meaningful if the network exists and continues to operate as intended. Without a network of users who believe in its properties, its utility disappears. The censorship resistance isn't a physical property like gold's conductivity. It's a property of the network's design and the shared consensus of the participants. For example, if the entire world suddenly lost internet access, Bitcoin's censorship resistance would be meaningless because the network couldn't function. Similarly, if the majority of the miners and nodes were co-opted or pressured into censoring transactions, a theoretical but highly unlikely event, the system's censorship resistance would be compromised. While gold possesses tangible uses in both industrial utility and ancient cultural value, Bitcoin's utility is entirely dependent on network belief, making it a difficult class of asset altogether. So no, I do not agree that Bitcoin is digital gold. Ultimately, Bitcoin's resilience on the network belief makes its value fundamentally different from gold. This distinction becomes even clearer when we compare it to truly productive assets, a point best articulated by Warren Buffett. Warren Buffett's analogy. I personally agree with Warren Buffett's analogy. In my journey as an investor, this is the single most compelling distinction. Unlike the farmland or the apartment buildings I could own, Bitcoin is an asset that simply sits there producing nothing. If you owned all the farmland or apartments in the world, you'd be a trillionaire because they generate cash flow or produce something tangible. Farmland produces crops and apartments produce rent and provide shelter. These productive assets have intrinsic value because they have an underlying economic utility that can generate wealth independently of market sentiment. For farmland, its intrinsic value is tied to its ability to produce food. If the market crashes for crops, the land can still produce food, and that potential holds a base level of inherent worth. For apartments, their intrinsic value is tied to their ability to generate rent and provide shelter. Even in a housing downturn, the building still stands and you can still house people, offering a fundamental utility. Unlike farmland or apartments, which are assets that work for you by producing crops or generating rent, Bitcoin is an asset that simply sits there. Its value isn't a function of what it produces, but what someone else might one day pay for it. But the dollar argument debunked. Proponents may assert that the dollar bill produces nothing, but this is a false comparison. The dollar's value is grounded in the full faith and credit of the US government, the US government's ability to tax its citizens, and a massive productive economy. It's a claim on real-world output, not a claim on nothing but itself. Bitcoin's value, in contrast, is a claim on nothing but itself. The payment system argument debunked. As a payment system, Bitcoin is slow and expensive for everyday transactions. While its censorship resistance is a powerful utility in specific situations, its value as a global currency is limited by its lack of practical day-to-day use for most people. The Bitcoin scarcity argument debunked. Bitcoin's scarcity of 21 million Bitcoins is a feature of its code, not a law of nature. Unlike the physical scarcity of a rare earth metal, which is a fixed and immutable fact, Bitcoin scarcity is an artificial constraint that exists only as long as its network participants agree to uphold it. The Bitcoin's physical network gives it value argument debunked. A Bitcoin proponent might argue that Bitcoin's network existence is a tangible reality like a physical road. While the network is technically reality, its value as a store of value is not derived from its physical properties but from a collective, a potentially fleeting consensus. The Bitcoin is anonymous debunked. The popular belief that Bitcoin is a tool for complete anonymity is a significant misconception and has persisted since its early days. Every single transaction from its first block in 2009 to the present day is permanently recorded publicly on the ledger. This means that anyone can view any transaction, the amount of Bitcoin transferred, and the addresses involved. Think of a Bitcoin address like a real mailing address. Anyone can send you mail at that address, and anyone can see who sent your mail and when. However, the mailing address itself doesn't automatically reveal your name. The problem is, if your mailing address is ever linked to your real identity, for example by having a package delivered with your name on it, then every piece of mail you've ever received or sent can now be tracked back to you. You can be de-anonymized in 3 ways. Centralized exchanges, KYC, AML. These exchanges are legally required to verify your identity. Second, blockchain analysis software to trace the flow of funds. Identify transaction patterns and cluster addresses that are likely controlled by the same person or entity. Lastly, a common mistake that severely compromises privacy is reusing the same Bitcoin address for multiple transactions. This links all the transactions together, making it easier for the observer to build a comprehensive profile of a user's financial activity. Some Bitcoin proponents argue that it is possible to achieve a high degree of privacy, but these methods are often complex, inconvenient, and not truly anonymous. Unlike a privacy-focused cryptocurrency like Monero, which is specifically designed for features like ring signatures, stealth addresses, and confidential transactions to obscure sender, receiver, and transaction amounts, Bitcoin's core design prioritizes transparency and immutability. Conclusion: if you leave one Bitcoin for 10 years, it will still be one Bitcoin. It doesn't grow, it doesn't pay dividends, it doesn't generate income, it doesn't inherently produce a good or service in any way. You're simply holding a digital token hoping its price will increase, whereas farmland would have produced crops and the apartments would have produced rent. For Bitcoin, if the market sentiment disappears and people stop believing in its value, what is left? From my perspective, there's no underlying factory or physical asset generating value. Its utility as a medium of exchange or a store of value is entirely dependent on the network effect and the belief in its properties. If that belief wanes, its prospective value and utility could indeed diminish significantly, possibly even to zero in its extreme scenario of complete abandonment. I've purchased Bitcoin in the past, but now that I truly understand it, I'm staying far, far away from it. The only time I would think about buying cryptocurrency is if I was affected by mass censorship. This is why, for the specific use case of censorship resistance, I would not turn to Bitcoin but Monero, an asset built with privacy as its primary and arguably more tangible utility. Ultimately, the value of Bitcoin is not found in a factory, a farm, or a balance sheet. It is an intricate and fragile construct built on twin pillars of human speculation and shared belief. And when that belief fades, so too does its value. A construct that will undergo a true test if and when that belief wanes. What is a digital token worth when no one is willing to buy it? Without a factory, a farm, or a balance sheet, what is left to catch its fall? The true test of Bitcoin's value will not be found in its price chart, but the enduring strength of a belief that, for now, holds its illusion. This video was edited, researched by me, Miles Charlatan, and not gonna lie, a little bit of AI prompting. And if you enjoyed this video, make sure to like and subscribe and all that good stuff, and I'll see you in the next one.